I just missed the high-end street consensus for Q2 2026. And, well, to understand the drop, you really have to look at a massive split in
All
expectations.
right, it was a completely fractured consensus.
Exactly. So let's just get right into the print. Revenue came in at $202,000. And for earnings per share, non-GAAP EPS was negative $0.17.
Which that actually misses the negative $0.16 estimate.
Yeah, it does. And on a GAAP basis, you're looking at a net loss of $10.0 million. So that's about $0.22 per share.
Right, and then there's the guidance.
Right. Management reaffirmed their full year 2026 cash consumption target, keeping it between $30 million and $35 million.
And, I mean, the market reaction was swift. It was punishing.
Oh, absolutely. Shares dropped 3.17% to $1.22 during regular trading. And then, they just slid further down to $1.20 in the after-hour session.
But, the paradox here for retail investors analyzing this print, it's just glaring. You see a headline miss against a $392,000 high-end estimate, and, well, the algorithms just sell.
Right. The bots just take over.
Exactly. But look at the actual baseline here. Revenue is up 9 times year over year.
Wait, 900%.
Yeah, 900%. I mean, they posted a mere $22,000 in Q2 of 2025.
Oh, wow. That is a tiny baseline.
Right. And at $202,000 this quarter, that top line number effectively doubled sequentially from Q1 2026.
Okay, so the market is actively punishing a stock for missing a model target, while the underlying business is simultaneously delivering, 900% year over year and 100% quarter over quarter growth.
That is exactly what's happening. And to make sense of a market reaction that just seems entirely disconnected from the percentage growth, you really had to pull back the curtain on the analyst models heading into this print.
Yeah, looking at the coverage, it felt like Wall Street was evaluating two completely different companies.
Oh, completely. You had this severely fractured consensus, which just creates chaos for a pre-scale hardware company like this.
So break that down for us. What were the tracking networks actually saying?
Well, the divergence was massive. On one side of the aisle, you had the high-end models, so places like investing.com and Reuters.
Okay.
They were modeling that really ambitious $392,000 in revenue and a negative $1.16 EPS.
So they were essentially pricing in like a rapid vertical acceleration in commercial sales.
Exactly. They wanted a hockey stick graph right now. But on the other side, you have the low-end trackers like
Yeah.
Marchart and MarketBeat.
And what were they looking for?
They were modeling a much more conservative range, around $180,000 to $183,300 in revenue, with a negative $1.17 EPS.
Okay. And then the El Seg mean was sitting right in the middle, roughly $275,000, right?
Yep, right in the middle.
So looking at those numbers, I actually cleared the low-end bar by over 10%.
They did, but, the market clearly doesn't grade on a curve.
No, definitely not. They took a massive hit because they missed the high end by nearly 49%, and then they missed that middle ground mean by about 26%.
Right, which triggers the sell-off.
It honestly reminds me of a high-stakes venture capital pitch.
Oh, that's a good comparison. How so?
Well, imagine you're standing in front of a VC board, right? One board member just wants to see a working, validated prototype out in the field.
Right, just proof that the tech works.
Exactly. But another board member, they're sitting there expecting like $1 million in annual recurring revenue already.
Yeah, completely different expectations.
So hitting $202,000 in early sales is like a popping champagne victory for the first board member, but it triggers massive red flags for the second guy.
That's a perfect way to look at it.
Huh.
Because, well, the reason that second board member is panicking is because those expectations dictate the valuation entirely.
Right.
When a company's revenue is still measured in the hundreds of thousands, but their operating expenses are measured in the tens of millions absolute dollars, matter far less than the implied velocity of commercialization.
So the high-end models just assumed a much steeper adoption curve this quarter.
Exactly. They were implying that AEye was rapidly converting those test units into bulk orders, whereas the low-end models just assumed the more methodical, slow-burn reality of hardware procurement.
And the stock drop basically tells us the market had already priced in that aggressive timeline.
Yep, they priced in perfection.
Which really brings up the crucial question for anyone holding this stock or, anyone looking to buy the dip, what is the actual quality of this $202,000?
Right. Where's the money coming from?
Yeah. Are these real, repeatable commercial sales, or are we just looking at more paid testing and evaluations?
It's the million-dollar question. Or I guess the $202,000 question.
Yeah, exactly. Because if this revenue is just global automakers paying for a handful of evaluation units to just, tinker with in an R&D lab, that's not a sustainable, scalable business model.
No, it's not.
Yeah.
But the operational metrics provide a fairly clear answer to that.
Yeah.
And management actually made a point to emphasize this shift on the call.
Okay. What did they highlight?
Well, their CFO, Connor Tierney, specifically noted that revenue generation is actively transitioning away from those paid evaluations. It's moving toward actual commercial agreements.
Interesting. Do they have the customer numbers to back that up?
They do, yeah. If you look at the active customer base, the number of revenue-generating clients grew to 25,
Okay, so up from what?
up from 21 in Q1.
Right.
So that's a 19% sequential increase.
Got it. So the top of the funnel is definitively widening. I mean, more companies are opening their wallets, even if the check sizes are still, relatively small.
Right. And the pipeline momentum really supports that widening funnel. Total quotes are up roughly 40%, and active engagements are up over 25% just quarter over quarter.
Wow, 40% jump in quotes is solid.
It is. But the real story isn't just the sheer volume of engagements, it's the source of the traction.
You mean the specific industries they're selling into?
Exactly. The defense sector is just the absolute standout vertical for AI right now.
Yeah.
Engagements in defense actually doubled quarter over quarter.
Doubled. That's huge. And didn't their lead defense customer just do something significant?
Yeah, they just placed their third consecutive paid order.
Okay, 3 consecutive orders. That is a genuine pattern. It really implies the tech has moved out of that evaluation phase and is actually being integrated into a continuous supply chain.
It definitely looks that way.
But, as I was reviewing the sources for this quarter, the vertical that really caught me off guard, it wasn't defense and it wasn't automotive.
Oh, you're talking about the sports deal.
Yes, the
It's
sports deal. I signed a sports analytics agreement with a company called AEye 3D, utilizing their Apollo sensor.
Yeah, that surprised a few people.
I mean, using LIDR for sports stadium analytics, that seems like a massive pivot for a company that's primarily known for autonomous driving.
It does seem like a distraction at first glance. But when you break down the mechanics of a software-defined LiDAR architecture, it actually makes a lot of sense.
Okay, walk me through that. Because normally, traditional LiDAR systems just operate like a spinning flashlight on top of a car, right?
Exactly. They just blindly eliminate everything in a 360-degree circle.
Mm-hmm.
It gives you a broad but relatively rigid picture of the environment. But software-defined LiDAR, which is what AEye's Apollo sensor is, it functions more like a highly intelligent laser pointer.
So instead of just spinning blindly, the software tells the physical laser exactly where to look and, how much detail to capture.
Precisely. The physical hardware actually remains identical. It's the software that dictates the scan pattern, the range, the resolution, all based on the immediate need.
Oh, that's fascinating.
Right. So if you're selling to a defense contractor, the software might instruct that exact same Apollo sensor to stare intensely at a single fast-moving object 3 miles away for, say, missile targeting.
Okay.
But if you're selling to Alive 3D for sports analytics, the software just instructs that identical hardware to create a wide, dense, rapidly updating field of view to track the complex movements of players running across a field.
So they don't have to build a new sensor for the stadium. It's the same box.
Same box, just different code.
Wow. That makes the technology incredibly adaptable. And, we did see progress in their traditional auto and OEM space as well.
Yes, their roadmaps for Level 3 and Level 4 autonomous driving are expanding.
And just to ground that for our listeners for a second, Level 3 autonomy involves conditional hands-off driving, right? Where the car handles most tasks, but a human still has to be ready to take over.
Right, exactly.
While Level 4 means the vehicle can operate entirely without human intervention, usually within specific geofenced areas.
Yeah, like robotaxis.
Yeah.
And the fidelity required from a sensor at those levels is literally life or death.
Which makes their recent integration highly significant. The Apollo sensor was just validated on the NVIDIA Drive AGX Thor platform.
Yeah, that is a big deal.
It places AEye squarely inside the NVIDIA Drive Hyperion ecosystem, which to me feels like a massive procurement shortcut.
What do you mean?
Well, if NVIDIA's Hyperion is the reference architecture that global automakers use to build out their autonomous fleets, being validated on that system means automakers don't have to spend years integrating AEye from scratch.
Oh, absolutely.
It just becomes a pre-approved plug-and-play component.
Right. It reduced the friction of adoption significantly for those OEMs. And, alongside all this product revenue, AEye actually unlocked a brand new revenue stream this quarter.
Right, the contract development revenue.
Exactly. They book a $30,000 contract from an aerospace and defense customer, specifically for customer-funded engineering work.
Okay, but I have to push back a little on this broader strategy here.
Sure, go ahead.
Because they're taking one core physical platform, Apollo, and attempting to sell it for military defense targeting, for sports stadium analytics, for level 4 highway driving. And now they're taking on bespoke engineering projects for aerospace clients.
Right.
Does this software-defined approach actually create sticky, scalable business across the board, or does it risk stretching a small, cash-burning company completely thin across a dozen disparate projects?
That is the core debate.
I mean, it just feels like they risk becoming a jack of all trades, master of none, constantly writing custom code for every $30,000 contract that comes across the desk.
Yeah. Yeah, and that tension between focused execution and capturing broad market share, that is the central debate for their board right now.
I'd imagine so.
The bull case for this architecture is that you don't have to build a new hardware factory for every new customer. You amortize your heavy R&D costs across multiple uncorrelated industries.
So if the auto market slows down, defense might accelerate.
Exactly. But the bear case aligns perfectly with your concern. Selling into multiple, wildly different verticals requires a massive scale of operational support.
This is a lot of overhead.
Huge overhead.
Hmm.
And that forces us to look squarely at the other side of the ledger. We really have to analyze how much AEye is spending to generate that $202,000 in revenue.
Right. The margins. And let's be blunt here. The current math is brutal for a retail investor to look at.
It's tough.
We are seeing the harsh reality of an early stage hardware ramp before that volume inflection hits. Gross margins are still negative. They posted a Q2 gross loss of $161,000, which means the physical cost to produce, assemble, and deliver the goods they sold was $161,000 higher than the $202,000 they actually collected from the customer.
Yeah, it literally currently costs them more to manufacture the product than they can sell it for.
Ouch.
And that gross loss is calculated before you pay a single software engineer, before you pay the executive team, and, before you even pay rent.
Right. That's just the cost of goods sold.
Exactly. So once you add those operating expenses, the ledger gets incredibly heavy. GAAP OPEX hit $10.6 million for the quarter. Non-GAAP OPEX was $8.2 million.
And both of those figures are up sequentially from Q1, right?
Yes, they are. So when you blend the gross loss and the operating expenses together, their adjusted EBITDA sits at a negative $8.3 million.
Wow. Burning over $8 million in adjusted operating expenses to generate a $161,000 gross loss. I mean, that is a ratio that requires immense investor patience.
Immense.
How on earth does management plan to scale out of this unit economic hole without building, billion-dollar fabrication facilities that a company of this size clearly cannot afford?
Well, the entire viability of their business model rests on their manufacturing strategy. Management's plan to mitigate capital expenditures relies almost exclusively on contract manufacturing.
Okay, who are they partnering with?
Specifically, their partnership with Lithium. Lithium has established a dedicated, low-capex production line that is currently capable of producing 60,000 Apollo units annually.
That's a solid run rate.
Yeah. And AEye is supplementing this capacity with Chinese manufacturing and distribution partnerships through companies like ATI and LightTekton.
Okay, so it's essentially an attempt to replicate the fabless semiconductor model, but in the LIDR space.
Exactly.
You look at giants like AMD or NVIDIA, they design the brilliant underlying architecture, but they don't spend multi-billions building the fabrication plants.
Right. They let TSMC handle the heavy lifting of physical manufacturing.
Yeah. So AEye's designing the Apollo sensor and writing the proprietary software, but they are letting Lithium absorb the manufacturing capex.
Exactly. Letting a partner absorb the facility costs keeps AEye's balance sheet relatively light compared to traditional legacy hardware manufacturers.
Sure.
But outsourcing your manufacturing doesn't mean your costs just disappear entirely.
No, definitely not.
You still have to pay for the inventory, the tooling, and the working capital up front before you can sell a single unit.
Right. And when you're burning over $8 million a quarter, those upfront costs force us to look directly at AEye's bank account. Survival in the hardware space is basically just a function of liquidity.
Always is.
Which brings us to the cash runway. If the company is burning at this rate, the very first metric any institutional or retail investor will check is the remaining cash pile. How long can they keep the lights on?
Well, AEye ended Q2 with $71.5 million in cash equivalents, and marketable securities.
Okay.
And a really critical point of strength here is their capital structure. They are virtually debt-free.
That is huge.
Yeah. They eliminated their convertible notes previously, which leaves just a negligible $146,000 note remaining on the books.
Man, that is a massive saving grace.
Oh, completely.
I mean, in a macroeconomic environment where interest rates have been elevated, carrying no crushing debt service just gives management so much breathing room.
Right. Convertible notes in particular can be incredibly toxic for early-stage companies.
Because they often lead to massive shareholder dilution if the stock price drops, right?
Exactly.
Right.
It's a death spiral.
Mhm.
So eliminating those removes a very significant overhang.
It completely secures the balance sheet. But in terms of the actual cash burn, their Q2 consumption came in at $7.5 million.
Yep.
And management reaffirmed their full year 2026 cash consumption guidance, keeping it squarely in the range of $30 to $35 million, which notably includes about $5 million allocated just for working capital.
Right.
So if we have $71.5 million in the bank, and they're burning roughly $30 to $35 million a year, Basic Division tells us that gives them about 2 years of life support at the current run rate.
And management explicitly reinforced that timeline on the call. They stated they expect their current cash balance to provide an operational runway well into 2028.
Okay, that's solid.
However, there is a critical note for the back half of this year that investors really need to model out. Management expects cash consumption to increase in the second half of 2026 compared to the first half.
Wait, if commercial revenue is theoretically scaling up and they're moving past the evaluation phase, shouldn't the cash burn start coming down? Why the sequential increase?
It circles back to that LIDR manufacturing ramp we just talked about.
Well, right.
While they avoid the facility capex, they still have to fund the inventory and the tooling ahead of time to prepare for the commercial demand they're projecting.
I see. You have to purchase the raw materials and the components before Lydian can even build those 60,000 sensors.
Exactly. That upfront working capital requirement means H2 cash burn will just be heavier.
Okay, this dynamic brings up a really fascinating analyst perspective on the company's valuation. Craig Hallam initiated coverage with a $3.50 price target.
Yeah, quite bullish.
Very. And a large part of the rationale for that bullish target is based on the fact that the stock trades below its cash value. Think about it. If a company has $71.5 million in cash, essentially zero debt, but its total market capitalization falls below that cash pile, it looks like a deep value play on paper.
It's a classic scenario of trading below net asset value. The market is essentially valuing the core business, the patents, the NVIDIA integration, the defense contracts at zero, or even as a liability.
But the massive fundamental risk for anyone jumping in purely on that deep value thesis is that the $71.5 million cash pile is not static.
Definitely not.
It's a melting ice cube. With JAP net losses running at $10 million a quarter, that net asset value dwindles every single day the market is open.
Yes.
So the crucial, really existential question you have to ask yourself is, can I convert these initial OEM evaluations and these early defense orders into massive, high-volume design wins before that runway well into 2028 completely evaporates?
That is the defining question for the entire enterprise.
Yeah.
Building blocks to that massive conversion are visibly falling into place. You have a defense customer placing repeat consecutive orders.
Right.
You have validation on NVIDIA's Hyperion ecosystem, which serves as a major gateway to Tier 1 automotive OEMs.
Exactly.
You have a scalable software-defined architecture entering new verticals like sports analytics. But at the end of the day, a pipeline of 25 proof-of-concept customers must translate into multi-year, high-volume production contracts.
It has to, just to cover a $10 million quarterly operating expense and flip those gross margins positive.
Absolutely.
So let's synthesize this for the retail investor tuning in right now, trying to make sense of the earnings print and that stock drop.
Sure. The core thesis is this. AEye is successfully growing its top-line percentage metrics at an exceptional rate.
Yeah, 9x year over year.
Achieving 9x year-over-year growth and 100% sequential growth is objectively strong execution.
For sure.
They are securing sticky repeat orders, particularly in defense, and they're establishing new high-margin revenue streams like contract engineering. And this is it remains a highly speculative, cash-burning turnaround play.
Yeah.
It's a company waiting for a massive commercial volume inflection. And until that inflection hits the manufacturing line, those gross margins will likely remain negative, and the market will remain skeptical.
They have a pristine, debt-free balance sheet to survive the near term, but the clock is undeniably ticking on that melting ice cube, which really leaves you with a final, provocative thought to mull over as you analyze this space.
What's that?
Well, we've talked extensively about AEye's internal runway, the fact that their $71.5 million safely extends their operations into 2028.
Right.
But the real race here might not actually be against bankruptcy tomorrow. The real race is against the broader macroeconomic timeline of Level 3 and Level 4 autonomous vehicle adoption.
Oh, that's a great point.
If global automotive OEMs decide to delay their autonomous roadmaps by another 2 or 3 years, whether that's due to regulatory hurdles, consumer pushback, or just software limitations, will even a debt-free balance sheet be enough to help II cross the chasm?
That's the million-dollar question.
Because you can have your internal metrics perfectly aligned, your technology validated on NVIDIA, and your contract manufacturing ready to scale. But if the global market simply isn't ready to buy at massive volume, your internal runway might end before the macroeconomic plane ever takes off.
It just highlights the ultimate risk of the sector. Hardware commercialization is never just about your own internal execution. It's intrinsically tied to market timing and the readiness of your end customers.
Exactly. A brilliant technology means nothing if the buyers just aren't ready to deploy it. Make sure you hit follow on the show so you don't miss our daily earnings coverage as we continue to track these commercial rollouts. See you next time.